Hurricane Michael is poised to make landfall in Florida today. Oil rose above $74 a barrel as the storm was upgraded to a Category 4. It is expected to bring upwards of $15 billion in damages. Yesterday, in an interview with Bloomberg, the IEA executive director, Fatih Birol, warned that the oil market is entering a red zone. Well, joining us now, Jeffrey Currie. He's Goldman Sachs Global Head of Commodities Research, and also still with us, Dan Morris of BNP Paribas. So, Jeffrey, first of all, thank you for coming in London. We saw you a couple of weeks ago in New York. Thank you for sticking around, Dan. Overall, so we had this interview with Fatih Birol, saying oil may be in a red zone. What does that mean? Is it starting to hurt the world economy? Is it becoming dangerous levels? And why is OPEC not doing more?
It's really, there's a mismatch between financial flows and the physical market. The red zone is in the forward curve. It's in the future prices where you've seen substantial hedging. Yeah. I want to say bona fide hedging by both consumers, investors, and the back end of that curve. The shape of the curve tells you about the fundamentals. It is not in a red zone. Fundamentally, today, this market is relatively well supplied, a modest deficit given by the backwardation, nothing to fear. The question is the market's trying to price an unknown decline in Iranian supplies against an unknown capability of OPEC to increase. What do we know thus far? Thus far, inventories built in August and in September, given the high-frequency data, which is consistent with the forward curve. So I think the way I would say it is the back end of the forward curve is pricing an unknown red zone. I think it's a little premature at this point to be getting that concerned.
Okay, so Jeff, when OPEC actually tells us, and Russia, but especially Saudi, saying, look, they're going to sell if there's demand, but at the moment there just isn't that increased demand, they're right.
Right. When you look at the front end of that forward curve, it is not that tight. Now, I want to be careful. We're not saying we want to short oil or anything, right, but we think, the calls for $100 oil at this point are not justified yet.
What's the mystery right now, Jeff Currie? You're going to sit down and write an acclaimed Jeff Currie 25-page report. You got a team of 5 young Turks helping you. What's the mystery in petroleum, in hydrocarbons, upstream, downstream? What's the thing you just don't know right now?
When you look at what I've been doing over and over for the past, I would say, 2 months, it is the reverse of what we did in the 2000s, meaning that month after month, we take up, let's say, U.S. demand by 100,000 barrels per day, take China and EM down by 250,000 barrels per day, and we see the dollar getting stronger. What happened in the 2000s? The exact opposite. We took demand down in the U.S. substantially and then took up China and the EM, and the dollar got weaker. What was that dynamic that was playing out? Is that you actually had to make room for strong Chinese demand growth. We look at it today, you can't really make the same parallel assessment between U.S. and China. And I'm stuck with what is the market trying to price at the margin right now? And I go back to what is the U.S. really short? It is short labor. And what are we seeing in commodity space right now? We're seeing big victories by labor for the first time in decades. We've seen it in Chile. It's happening over in the commodity space, particularly in the emerging markets. And I'd say that's the one that I'm really focused on about why are we seeing this exact reverse pattern of what we saw in the 2000s.
Okay, and so is that priced in the markets? I mean, why are we seeing, first of all, the reversal? What's the answer to that? And what are the markets misjudging that?
Well, I think in terms of, putting the finger on where I think the markets are misjudged, there was a belief that, hey, you got, let's say, 8% interest rates in emerging markets, and you've got, 3% interest rates in the U.S., you'll still see the capital flow. What we see in commodity space, and I think of the EM as being long cycle, old economy, DM, short cycle, new economy, and even like oil, shale, DM, short cycle. And what we're seeing is you look at the returns on a commodity project in the EM right now, they're 20%. And this is the bull story that everybody is bulled up on in oil is this whole idea. There's no investment going in long cycle. So even at a 20% return, the dollar gets stronger, drives down the cost of these. You're still not getting the capital to flow. And I think it's issues around decarbonization, trade wars, all these things. Nobody wants long cycle projects in the emerging markets, and that's really what's driving this.
Back to oil specifically, but also Hurricane Michael. Do we have any estimate on how much that will be taking off the market? And if the Iranian sanctions are deeper, right, than thought, could Saudi Arabia come in and supply the market by enough, or will we have to tap on reserves because they don't have enough of the quality oil?
Well, I think first let's talk about Hurricane Michael. I think there's the question of loss in production versus loss in demand. And in terms of thinking about the loss in production, the hurricane's going to force shutting down about 40% of the Gulf of Mexico, which is a couple million barrels over a couple of days. The eye of the storm's going to miss all the infrastructures. There's no permanent damage concern. Now, the other concern is once it hits land is what kind of damage do you do to demand, taking out potentially refineries or, consumption of, petrochemicals and other types of facilities that are in the Gulf Coast. Our estimate on that, on average, would be about 100,000 barrels per day. So the net of it at this point right now probably favors being a little bit bearish as opposed to bullish.